In 1999 and 2000, the stock market was euphoric. Stocks were rising at parabolic rates. Companies were rushing to do IPOs. Any stock, even remotely .com related, was rallying to insane valuations. Then, suddenly, it all came crashing down. Stocks began to sell off at a rapid pace. And by the time stocks finally stopped falling at the end of 2002, the S&P 500 was down nearly 50%. The NASDAQ had fallen over 80%. Apple stock was down over 90%. And Amazon stock was down over 95%. Today, the AI bubble is even larger than the .com bubble was. For those of you who are new to this channel, welcome. My name is Stock Curry. I'm a former Merrill Lynch and Morgan Stanley investment banker, and I have over 25 years of trading experience. I traded during the .com bubble, and I remember it well. As we compare the AI bubble today to the .com bubble in the early 2000s, I'm going to show you how the AI bubble today, in some ways, is much larger than the .com bubble was in 2000. And we're not just talking about dollar amounts here. Obviously, the stock market is much higher today than it was in 2000. But a lot of that is due to inflation and money supply. So in a minute, I'm going to show you some charts that remove inflation and remove money supply from the equation to give you a better idea of how today's AI bubble actually compares to the .com bubble in the year 2000. Now, even though a dollar comparison doesn't really mean much, when you overlay the current AI bubble on top of the .com bubble from 1999, the similarities are shocking. Here is what the .com bubble chart looked like. As you can see, it featured a major rally followed by a major crash. And this is what today's chart looks like. It's a rally going straight up with seemingly no end in sight. After all, a lot of people today believe that stocks only go up and that you should always buy the dip. But when you overlay these two charts, a pattern starts to emerge. In fact, the charts are so similar, you can barely see where today's candle chart ends and the .com bubble begins. But this overlay also brings a little bit of hope, because when the .com bubble was in the same stage that today's AI bubble is in, it continued to rally for another year before topping out and crashing. So there's still a chance that the stock market could rise another 20 to 30% before topping out and starting to crash in 2026. But that doesn't mean we're safe, because while history does rhyme, it does not always repeat. And that means the AI bubble could burst at any moment. And when the AI bubble does burst, the fall could be even greater than what we saw during the .com bubble. That's because the AI bubble today is even larger than the .com bubble was in the year 2000. To show you how the AI bubble today is larger than the .com bubble was in the year 2000, I'm going to show you the forward PE ratio comparisons between these two periods of time. The reason I'm using forward PE ratios and not trailing PE ratios is because forward PE ratios already include the forward expected earnings of the company. And while trailing PE ratios can vary widely between different periods of time, forward PE ratios tend to be fairly steady throughout history. That means they're a great indicator and a great way to compare different valuations of the stock market over time. During the dot-com bubble, the forward price to earnings ratio of the S&P 500 peaked at around 24 in the year 2000. Keep in mind that every single time you see a 22.5 forward PE ratio or higher, a drawdown is near. During the AI bubble that we're currently in, the peak forward PE ratio hit 24.47 in December last year. And it was still at 22.89 before Friday's sell-off, which is still above the 22.5 level that indicates a drawdown is near. That means that at the height of the AI bubble in December, the forward PE ratio was actually higher than the height of the dot-com bubble. And the Case-Shiller Index is another measure used to determine if stocks are overvalued or not. As you can see on this chart, we're currently much higher than where we were when the Great Depression started. The only other time in history the Case-Shiller Index was higher was during the dot-com bubble, and it wasn't that much higher than where it is today. If we zoom in, you can see how we're not currently that far off from where the S&P 500 was during the height of the dot-com bubble. And the fact that we're close, but not quite there yet, lines up with the chart overlay that I showed you earlier that indicates the stock market might continue to rise for a few more months before finally topping out and starting to fall. Now let's take a look at the S&P 500 chart and let's remove the effects of inflation and government money printing. It should be no surprise that when the government prints money, this causes inflation to go up, and it also causes the stock market to go up. After all, if prices go up, then companies' revenue and profits go up, and that's what sends stocks higher. So one way to filter out that noise and look at how stocks are actually performing is to remove inflation and compare the S&P 500 to the M2 money supply. And when you do that, you can see how the only other time in history where the inflation-adjusted S&P 500 was higher was during the dot-com bubble, meaning the S&P 500 today is now the second most overvalued it's been in history. And if it rises just a little bit higher over the next few months, we will reach the peak of dot-com bubble valuations. This is yet another red flag that stocks are overvalued and about to crash hard. Just how hard might stocks fall? Well, take a look at this. Investors are now buying stocks on margin at the largest level in history. You may be familiar with buying stocks on margin. That's when you borrow money from your broker in order to buy more stocks than what you could with only the amount of cash available in your account. And according to FINRA, the amount of stocks being bought on margin just crossed $1 trillion in June for the first time in history. But there's another type of margin that large institutions use, and that is called a carry trade. A carry trade is when someone borrows money from one location in order to place a stock trade in another location. Because Japan has the lowest interest rates in the world, or at least they did up until a few months ago, people borrow yen currency from Japanese banks, then carry that money to the United States in order to trade US stocks. When US stocks are sold and the currency is carried back to Japan, this is known as a carry trade unwind. When carry trades are unwound, it often causes sudden and massive drops in the US stock market. As you can see on this chart, the stock market is being propped up by borrowing by the largest margin in history. And every time these carry trades unwind, it causes a massive and sudden decline in the stock market. We saw that in the year 2000 when the dot-com bubble burst. We saw it again during the COVID crash, and we saw it again during the 2022 bear market. When the current carry trade becomes completely unwound and people switch to buying more stocks with cash than on margin, we are going to see one of the largest drops in the stock market in US history. It's no longer a question of if the stock market is going to crash. It's a question of when is the stock market going to crash. Unfortunately, trying to time when the AI bubble is going to burst and the stock market is going to crash is impossible. As you can see on this chart, when forward PE ratios reach the level they are at today, it's anybody's guess where the stock market will be 1 year later. Half the time the market is higher and half the time the market is lower. And like we talked about earlier, there's a good chance the stock market could continue to rise for another year before topping out. But when you look at where the stock market is 10 years later, that is when a very clear picture starts to emerge. Every time the S&P 500 has reached the current forward PE ratios or higher, the stock market is always 100% of the time lower 10 years later. Now, if you're young, that might seem like a crazy concept for the stock market to be lower 10 years from now than where it is today. But if you're older like I am, you remember how after the dot-com bubble burst, it took 12 years for the S&P 500 to reach new all-time highs again, and it took 14 years for the NASDAQ to reach new all-time highs. But even if the stock market does crash, this is not the time to panic, because there are opportunities everywhere for both stock investors and options traders. One option for stock investors is buying value stocks instead of tech stocks. After the dot-com bubble burst in the year 2000, US value stocks outperformed for years. Another option is buying small cap stocks instead of the large mega cap stocks. In the late 1990s, small caps underperformed, just like they're doing today. But when the dot-com bubble burst in 2000, not only did they fall less sharply than large caps, they also went on to outperform for a few years. And we're seeing that again in 2025, with small cap stocks now underperforming tech stocks by the largest margin in history, which means small caps could outperform tech stocks by the largest margin in history when the market crash starts. I had someone reach out to me a few days ago, and they asked me if there was an ETF for small cap stocks. And there is. It's called the Russell 2000, and the ticker is IWM. Buying the IWM ETF is probably the easiest way to move your portfolio into small cap stocks when this stock market crash starts. Now, my favorite way to make money as the stock market crashes is to buy put options. Put options are risky. You could lose your entire investment. But when you're right, they provide an exponential return. During the Trump tariff correction earlier this year, I turned $1,000 into $32,000 in just 1 month by buying put options. And that 3,200% return was made with just a small 20% drop in the stock market. Imagine how much I would have made had the stock market fallen by 50% or even 80% like it did during the dot-com bubble. And I want you to know that every trade I made to turn $1,000 into $32,000 was alerted live in the Stock Dads Discord. And a lot of people in the Discord copied my trades and made a lot of money with me. And when it was time to close those put options and switch to call options, I let people know that. And we turned right around and made money on the way back up with call options also. And just last week, another full-time professional options trader in the Stock Dads Discord made a ton of money when he correctly predicted that the market was going to go down. Last week, Duke Nukem alerted that he was buying 2 put options and planning to hold overnight. He bought 1 put option on PANW and another on SOFI. Overnight, PANW fell 7%, and SOFI also fell 7%. Duke ended up making a 100% profit on SOFI and a 244% profit on PANW overnight. And it's not just Duke and I. We have over 30 full-time professional traders in the Stock Dads Discord, and many of us are multi-millionaires. If you'd like to follow us and copy our trades so that you can potentially make money like this in your portfolio also, check out the Stock Dads Discord in the first link in the description below. The fact is, when the AI bubble bursts and the stock market crashes, it could provide a once-in-a-lifetime opportunity to make you a millionaire. That's right. The AI bubble could make you a millionaire. You just have to change your mindset from buying only tech stocks because stocks only go up to buying value stocks and small cap stocks. And use your trading funds to short the market by selling call options and buying put options. And if you make enough successful trades, you could literally become a millionaire over the next 2 years. People did it during the dot-com bubble crash. They did it in 2008. They did it during the COVID crash. And now it's your turn.